As taxpayers, most of us welcome any type of income that won't increase our federal tax bill. I know it feels like the IRS likes to tax every dollar that you get, but there are some tax-exempt investments out there. We're going to take a look at 3 types of tax-exempt investments, along with some examples, but I'm not a financial advisor, and I'm not giving you financial, tax, or legal advice. Each situation is different, so please check with your financial or tax advisor before you do anything. My goal here is to provide information on how you might be able to avoid federal income taxes on some of your investment income. Okay, our first type of investment is municipal bonds. Local, county, and state governments use municipal bonds to fund projects such as improving roads. Please keep in mind that although treasury bonds are issued by the government, they are not municipal bonds and are not exempt from federal income taxes. Also, if you're on Social Security, you have to be careful because municipal bond income would be included in your adjusted gross income, and this could increase the federal taxable amount of your Social Security income. Anyway, when you invest in a municipal bond, you are basically loaning money to the government. In return, you will receive a constant stream of guaranteed interest payments. But beware, beware, beware. The income and/or interest from some municipal bonds may be taxable, or you may get stuck paying alternative minimum tax. The alternative minimum tax mainly affects high-income taxpayers to make sure that they at least pay something in federal income taxes. So please watch out for bonds or bond funds that might put you in a federal tax situation. Speaking of bond funds, our second type of investment is tax-exempt bond funds. Both municipal bonds and bond funds offer the same tax benefits. Since bonds are usually sold in $3,000 to $5,000 increments, one of the benefits of a mutual fund over a bond is being able to buy fractions of a bond. Tax-exempt mutual funds can be a mixture of bonds and other government securities. Just like with municipal bonds, you may have to pay federal income taxes on some tax-exempt mutual funds. For example, if a fund manager sells a bond for more than its purchase price, you would have a taxable gain. That's why you should always look for funds that try to avoid federal income taxes altogether. Here are a couple of examples of bond funds. American Fund's tax-exempt bond F2 focuses on higher income bonds. The fund does not invest in bonds subject to the alternative minimum tax. It appears that this fund truly tries to provide only tax-exempt income. Now let's look at the Vanguard High Yield Tax-Exempt Fund, which tries to give investors high income. Although it says tax-exempt, it's possible that this fund may have capital gains that will result in investors having to pay federal income taxes. That's why you should thoroughly research any fund or investment, even if it says it's tax-exempt. Under the mutual fund category, we have tax-exempt money market funds. Money markets focus more on short-term debt. An example would be the Fidelity Tax-Exempt Money Market Fund, which tries to maximize income that is exempt from federal income taxes. Here, fund managers try to avoid securities with interest that is subject to the federal alternative minimum tax. Our final type of investment is tax-exempt exchange-traded funds. Exchange-traded funds are on the stock exchange and can be bought and sold just like stocks. ETFs will usually track an index that has a focus on bonds with high yields. An example would be iShares National Muni Bond ETF. This fund tracks an investment grade index. Before you start your research to find investments in the 3 categories mentioned, you might want to know about 3 ways to avoid paying federal income taxes on dividends. If you want to know more about that, please watch the video on the lower right of your screen. Take care.